Welcome to the Department of Economics Board of Advisors Annual Talk. This is usually in the fall. Because of the pandemic, it was postponed. And then through the hard work of one of our board members working with the Chicago Federal Reserve Bank staff, they were able to arrange today's speaker. So thank you very much to all of them. I have a couple things to talk about regarding simple things. We have a Q&A at the bottom of your screen. Type in questions and I will select questions to ask our speaker at the end of his talk. Second, this is being live streamed by a number of different groups, and including the Chicago Federal Reserve Bank and Oakland University. These will be posted, the recordings sometime, so you can pick that up also. That is about it. So I would now like to go and introduce Michael Mazzio, the Dean of the School of Business.
Well, thank you, Ron. And as the Dean, I've always been impressed with what the Economics Department, Ron Tracy, does, the faculty members, and his Board of Advisors. And so I think we have a great event here, and I'm pleased to be the Dean of this fine institution with such great members as Ron in the Department of Economics. And with that, I'd like to introduce our new Provost, Dr. Britt Rios Elvis.
Thank you, Dean Mazzio, and good evening, everyone. I too would like to welcome you to this very engaging and important event. I really think that our School of Business Administration, the Economics Advisory Board, and particularly Ron Tracy, chairperson of the Department of Economics, deserve a lot of credit for doing such a wonderful job of planning and managing this event. Not since the Great Recession in the late 2000s, and perhaps even beyond that, have we seen the state of our national and world economies weigh so heavily on the minds of many. Sustainability of our current economic structures is an academic scope of inquiry without question, but it's also a frequent topic of conversation at the dinner tables and the living rooms of people from all walks of life. Whatever may lie ahead of us, in a time of such great uncertainty, I am confident that learning more from Charles Evans will facilitate both our empowerment and reassurance in gaining a better sense of the economic challenges and opportunities before us. With this in mind, I also have to commend our event organizers for engaging such an accomplished and respected keynote speaker. Charles L. Evans has served as the President and Chief Executive Officer of the Federal Reserve Bank of Chicago since September of 2007. In that capacity, he serves on the Federal Open Market Committee, which is the Federal Reserve System monetary policy making body. Before becoming president, our speaker served as the bank's Director of Research and Senior Vice President. That role involves supervising the bank's research on monetary policy, banking, financial markets, and regional economic conditions. I think this helps explain why he will be such an insightful speaker this evening. Dr. Evans' personal research has focused on measuring the effects of monetary policy on U.S. economic activity, inflation, and financial market prices. Outside his work at the Federal Reserve Bank, he has shared his expansive expertise in economics while teaching at the University of Chicago, the University of Michigan, and the University of South Carolina. I should also note that Dr. Evans received a bachelor's degree in economics from the University of Virginia and a doctorate in economics from Carnegie Mellon University in Pittsburgh. If you think of questions during tonight's lecture, please post them to the moderator, who will present them to Dr. Evans at the conclusion of his talk. With all of this said, it is now my great privilege to welcome Dr. Charles L. Evans. Thank you.
Well, thank you very much. Thank you, Provost Rios Ellis, for that very kind introduction. And it's a great pleasure for me to join you, albeit virtually, In my remarks today, I'd like to discuss the state of the US economy and share my views on where the economy and monetary policy are likely headed. In addition, I will highlight how even an improving aggregate economy can mask distressingly wide economic disparities. The COVID-19 pandemic and the efforts to contain it have taken a heavy toll on the lives and livelihoods of many of our neighbors, friends, and coworkers. I cannot stress the costs of this tragedy enough. And ultimately, those who have the fewest resources have borne a disproportionate share of these costs. The pandemic has had devastating effects, and we are still far from the robust economy we had prior to it. Still, many sectors of the economy have shown great resilience in the face of the virus. Indeed, overall economic activity has recovered far more than most analysts had expected in the middle of last year. And I'm optimistic about the future. With increased vaccinations and continued support from fiscal and monetary policies, we should make significant strides toward returning to normal levels of economic activity as we move through 2021. The pandemic also has had an impact on inflation. Even before the pandemic, inflation had been running below the Federal Reserve's target of 2%, and today the situation is even worse. I expect it will be some time before inflation is back to where we want it to be. Monetary policy still has a good deal of work to do here. So before I discuss these points in more depth, I should note that the views I will be sharing with you are my own. They're not necessarily those of my colleagues on the Federal Open Market Committee or anyone else in the Federal Reserve System. Now, in terms of the current outlook for the economy, clearly last year was unprecedented. The behavior of the economy was not driven by familiar financial and business cycle developments, but rather by the pandemic. Public health mandated shutdowns and individuals' voluntary changes in behavior resulted in a sharp drop in employment and economic activity last spring. We saw a strong rebound in the summer as the most stringent restrictions were lifted, followed by more moderate growth in the fall as the snapback effect faded. Still, all told, the US economy shrank 2.5% last year. The toll on workers has been immense. The unemployment rate quickly rose to nearly 15%, actually closer to 20% when you account for measurement issues. By the end of last year, it had improved to 6.7%. But clearly, we have a ways to go before we get back to the vibrant economy we had on the eve of the pandemic, when the unemployment rate stood at 3.5%, and there were nearly 10 million more people on payrolls. Moreover, and quite disturbingly, the burdens of the pandemic have fallen disproportionately on minorities, women, and low-wage workers. As a macroeconomist and a central banker, I often focus on broad aggregate measures when gauging the performance of the economy. But even as these metrics improve, not all groups may benefit evenly. For decades, the US has experienced growing disparities in income and wealth across socioeconomic groups. And sadly, the pandemic has aggravated these long-standing disparities. Monetary policy can help with these problems by fostering a strong macroeconomy that provides more and better job opportunities for disadvantaged segments of society. But monetary policy alone does not have better, more targeted tools that are designed for addressing these issues. Those fall under the purview of other government policymakers, as well as the impressive efforts of many in the private sector. And I hope we all can give top priority to eliminating these inequalities. Let me return now to the macroeconomic outlook. While we still have a lot of ground to make up, the aggregate economy today is much better than I and many other forecasters had projected last spring. Many businesses and consumers were able to adapt to operating safely in the presence of the virus. And sadly, others simply decided to largely ignore it. The relative resiliency of the economy also owes a lot to fiscal policy, which provided substantial direct support to household income and included a variety of programs to aid distressed households and businesses. Furthermore, aggressive monetary policy actions helped by fostering considerably more accommodative financial conditions than would have prevailed otherwise. So, what's in store ahead? Returning to normal requires getting the virus under control. The biggest factor here is vaccinations. Once a sufficient share of the population is inoculated, people will feel more safe to resume a broader range of activities. The sectors where social contact is so important, such as travel and leisure and hospitality, can recover more robustly. In addition, education can return to normal. As a result, we will see further increases in aggregate spending and employment. At the same time, growth will be boosted by the fiscal policy package enacted in December, potential additional fiscal support, and continued accommodative monetary policy. All told, my baseline expectation is that the US economy will grow in the range of 5 to 6% this year. Once the vaccine-related impetus to economic growth is passed, and as the boost from fiscal support wanes, real gross domestic product growth is likely to moderate in 2022 and 2023. My forecast has it averaging in the 2 to 3% range. Given this path for growth, labor markets will continue to improve, and I expect the unemployment rate will return to close to its pre-pandemic level of 3.5% by the end of 2023. With regard to inflation, there's still a long way to go. In December, inflation, as measured by the core price index for personal consumption expenditures, was 1.5% on a year-over-year basis. That's well below the Federal Open Market Committee's goal of averaging 2% over time. As I'll elaborate more in a minute, the inflation outlook, particularly in the near term, is complex. But I expect underlying inflation won't be back to our goal until the mid-2020s. Now, economic forecasts always come with uncertainties and risks, but today we have more than the usual number. The main reason is that the principal drivers of the economy over the near term aren't typical business cycle factors. Today's drivers are the course of the virus and the actions taken to mitigate the pandemic's effects. Here, things could go better, or they could go worse than expected. More successful vaccine distribution and take-up, as well as other efforts to contain the virus, could pave the road to a faster recovery. Conversely, a slower expansion of vaccination or the spread of more infectious strains of the virus could slow growth. Indeed, several of my business contacts in the healthcare sector have expressed major concerns about some of the public's reluctance to be vaccinated, particularly among certain racial and ethnic groups. The degree of additional fiscal support that may be coming is also uncertain. The president has proposed a $1.9 trillion package, but the exact amount that will emerge from negotiations with Congress is unclear. As a placeholder, my forecast assumes a package about half that size will be enacted, which is similar to what many private sector analysts are building into their forecasts. Now, let me emphasize strongly that this is not an opinion about the appropriate size for the package, or it's not a prediction of the outcome of the budget negotiations. Those are jobs for the Congress and the president's administration. But since I have to put together a forecast, I have to make some assumptions, and this is sort of a middle of the road type of assumption. That's all that it is. One thing that is more certain is the continued support for monetary policy. My contacts stress that the current financial environment is extremely beneficial for growth, and I can assure you that the Federal Reserve takes this to heart. We're committed to using all our available tools to support the return to maximum inclusive employment and 2% average inflation. Returning to the long list of uncertainties, another issue is what economists call sectoral reallocation, or the effects on overall growth and inflation from activity shifting between sectors of the economy. Now, in every business cycle, some sectors do better than others. But as a result of the vast differences in how the pandemic has affected various households and businesses, the degree of sectoral reallocation today is truly extraordinary. For instance, as consumers reduced activities that required close personal contact, restaurants and personal care service providers took a huge loss. In contrast, in your hometown, automakers and their suppliers were able to change their production processes to operate safely. Moreover, demand for autos has held up relatively well during the pandemic. Higher income households have continued to purchase new cars and the demand for used vehicles has been boosted by fiscal stimulus payments and the desire to avoid public transportation. Now, these efforts haven't come cheaply. Automakers and many other manufacturers have overstaffed shifts and relied on temporary workers to cover for increased absenteeism due to the virus. They've also made substantial investments in personal protective equipment and other safety protocols. And many have allowed more flexible work schedules or paid for leave to help employees manage family illnesses or child and elder care difficulties. These sectoral differences have led to an unusual situation in which, even though overall unemployment is high and we're not back to pre-pandemic levels of activity, some firms are currently running into supply constraints that might impede their business plans and raise their costs. For example, for some time, my business contacts in manufacturing have been saying they face a shortage of workers, and more recently, I've begun to hear more about them raising wages. Another example is a microchip shortage in the auto industry. Several factors are in play, but this is mainly a sectoral reallocation story. When ordering microchips early last year, automakers and their parts suppliers underestimated the strength of the recovery. I think I said earlier that last year's second half was much stronger than I had originally thought it would be in the spring. That's part of this. Meanwhile, chip makers allocated more of their product to consumer electronics producers that benefited from a burst of demand. As a result, today automakers and their parts suppliers are struggling to find enough chips to meet production plans, and they see this shortage persisting for the next 3 to 6 months. In contrast to these stories, sectors hit hard by the virus, such as leisure and hospitality, travel, and commercial real estate, are experiencing excess supply and stranded resources. Of particular concern here are the continued job market woes of many low-wage workers. These workers can't easily transition to those places and sectors where jobs are available. This underscores the importance of continued fiscal support for these individuals to help smooth out the uneven incidence of the pandemic. So how do these factors balance out? Well, with 10 million fewer people employed today than before the pandemic, it's safe to say the problem of excess capacity and unused productive resources is a far greater issue than the supply constraints some firms are facing. But there are still important implications going forward. The labor shortages we hear about today appear to be largely due to virus-related absenteeism. These constraints should ease as more people get vaccinated, the virus threat abates, and education returns closer to normal. At the same time, the current resource slack in industries that have been heavily impacted by the virus will likely be absorbed as demand normalizes. Taken together, this means we could see aggregate growth numbers bounce around quite a bit as some large but transitory swings in activity occur while particular sectors readjust. Until these sectoral adjustments have run their course, it will be challenging to gauge the underlying cyclical dynamics of the economy. These sectoral developments have implications for inflation as well. As a result of shifting consumption patterns and business plans, we've seen large movements in prices of certain goods and services relative to others in 2020. For instance, in December, while hotel prices and airfares were as much as 15 to 20% below year-ago levels, consumers were paying 9% more to purchase household appliances, and there were seriously backlogs there on orders. Today, we see supply constraints and price pressures in industries where demand is very strong, such as construction materials, steel, and autos, but continued weak pricing in sectors where the virus has had a big negative impact on demand. Going forward, the unwinding of strong demand in some sectors and a sharp recovery in others could lead to new capacity constraints and higher prices in some parts of the economy. As the recovery gains momentum, it will be important to distinguish such short-lived, sector-specific phenomena from more widespread and lasting resource pressures. Overall, I expect to see higher top-line inflation numbers in the spring because of these temporary constraints In addition, we tend to look at average inflation over the past year, and there will be a mechanical increase in this average when the very low readings from last March and April roll out of the 12-month annual calculation. But after these factors have run their course, I expect inflation will settle down and end the year in the range of 1.5 to 1.75%. With continued growth, further improvements in labor markets, and accommodative monetary policy, I see inflation moving up steadily and eventually running moderately above 2% for some time, but that will be in the mid-2020s. This overshooting of 2% is a purposeful design feature of appropriate monetary policy. And let me elaborate on that now. Congress has instructed the Federal Reserve to foster economic conditions that achieve both stable prices and maximum sustainable employment. These two objectives are known collectively as the dual mandate. In order to achieve these goals, the Fed's response to last year's crisis was swift and strong. The Federal Open Market Committee quickly reduced the federal funds rate, our main policy tool, to a range of 0 to 0.25%, which is as far as we can effectively reduce it when trying to stimulate the economy. We also purchased large quantities of US Treasury and agency-backed mortgage-backed securities, and with the approval and backing of the Treasury Department, we activated a number of special lending facilities to support the flow of credit to businesses, households, nonprofits, and state and local governments. Although some of the lending facilities have lapsed recently, we've kept the federal funds rate in the 0 to 0.25% range, and since last spring maintained a steady pace of US Treasury and agency mortgage-backed asset purchases. Even before the pandemic hit, the Federal Reserve had been in the process of conducting a multifaceted review of our longer run strategy for achieving our monetary policy objectives. This review was motivated by trends that predated the pandemic. Importantly, because of the declines in the underlying trend growth rate of the economy and other factors, the Fed has less room to use its interest rate tools to stimulate the economy than it did in the 1990s and early 2000s. I won't go into the details here, but this means that without a change in strategy, inflation would get mired below 2% far too often. It also would be more difficult to achieve our maximum inclusive employment goal. We kept this review going through the pandemic, and last August incorporated its findings into a new monetary policy strategy statement. The inflation target remains at 2%, but we indicated that we now will seek to achieve inflation that averages 2% over time. Furthermore, we said that following periods when inflation has been running persistently below 2%, appropriate monetary policy will likely aim to achieve inflation moderately above 2% for some time. We also emphasized that maximum employment is a broad-based and inclusive goal, and stated that the FOMC will seek to eliminate shortfalls from maximum employment. In contrast, the old strategy sought to minimize both positive and negative deviations from maximum employment, not just shortfalls. These are important changes. Maximum employment means bringing as many people as possible into the labor force and creating conditions where they can find productive jobs. Importantly, monetary policymakers should not be concerned with what might look like very tight labor markets, as long as accommodative monetary policy is not generating unwanted inflation risks. We then put these strategies into action. In September, the FOMC provided output-based forward guidance on its interest rate policies by saying we will maintain the current 0 to 0.25% target range for the federal funds rate until we have achieved our employment mandate and inflation has reached 2% and is on track to moderately exceed 2% for some time. This overshooting after a period of sub 2% inflation is straight out of the new long-run strategy. Statement also recognized that our work on inflation is unlikely to be complete when we first begin to raise rates. So it indicates that we will maintain accommodative monetary conditions until our inflation averaging goal is met. In December, the FOMC added similar outcome-based forward guidance regarding our asset purchases. stating that the current pace of purchases will be maintained until substantial further progress has been made toward our policy goals. Note that there is no fixed date attached to these changes in interest rates or asset purchases. The timing will be dictated by the progress made towards our policy goals. Monetary policy will be accommodative as long as it takes to reach them. When I think about my economic forecast, I am reasonably confident that we will reach our maximum employment goal over the next 3 years. I am more concerned about the prospects for reaching our inflation mandate, however. Inflation is far too low today, and we have a long way to go to reach the magnitude of overshooting that I see as necessary to satisfy our average inflation objective. Because businesses and workers do not want to fall behind rising prices, expectations of future inflation have a strong influence on price and wage setting today. So bolstering the inflation expectations of households, businesses, and financial market participants will be key to achieving our goals. The strong pickup in economic activity projected for this year should generate a temporary boost to inflation also. But whether this becomes embedded into inflation expectations and produces a more sustained increase in underlying inflation, that's an open question. To help this process, it will be critical for monetary policies to look through any temporary price increases and not even thinking about adjusting policy until the economic criteria we have laid out have been realized. So I see us staying the course for quite a while. Now, before I conclude, I would like to touch on an aspect of the developments over the past year that has potentially large negative consequences for the long-term well-being of our communities. As I mentioned before, the pandemic has amplified a number of long-standing disparities in economic and other outcomes by income, race, ethnicity, gender, age, and geography. These disparities have the potential to inflict long-lasting damage, not only on the well-being of our communities, but on the nation's economy overall. One area of particular concern is the impact of the pandemic on children and young adults who have had their education disrupted. Many of these students have also experienced the trauma that comes from isolation, food insecurity, concerns about housing stability, and uncertain employment prospects for themselves and the adults in their lives. Left unaddressed, these disruptions could easily leave long-standing scars that would make it even more difficult for these young people to realize their economic potential and other aspirations. This would certainly weigh on the inclusive nature of the Federal Reserve's maximum employment objective, not to mention the individual hardships it would bring. At the Chicago Fed, through our Project Hometown initiative, we are interested in supporting strategies and programs that research has shown to improve the lives of young people, especially the most vulnerable and those impacted most by the disruptions of the pandemic. Summer jobs programs are one such promising intervention. Research indicates that by providing disadvantaged youth employment and enrichment opportunities, including soft skills development and access to mentors, summer jobs programs improve educational and employment outcomes and reduce the likelihood that young people become involved with the criminal justice system. Research also indicates that summer jobs programs have higher returns on each dollar invested than some alternative interventions. Based on these results, we at the Chicago Fed are seeking ways to promote increased participation by at-risk youth and potential employers in summer jobs programs. There are many local organizations, such as Grow Detroit's Young Talent in your area and One Summer Chicago, as well as many private sector businesses that have established an effective summer jobs programs. While the Fed is known primarily for its monetary policy responsibilities, community development and outreach are also key responsibilities for us. By adding the analytical expertise of our staff and resources to the efforts of community leaders and businesses, we are committed to improving economic opportunities for vulnerable youth and overcoming other longstanding inequities inequities in our society. To sum up, the US economy still faces significant challenges in dealing with the COVID-19 pandemic and the economic fallout from our actions to contain it. With significant effort, many households and businesses are having success working their way back to higher levels of activity, but many others have been hit hard by the virus and its fallout and face a tougher road back. For our part, the Federal Reserve is committed to using its full range of tools to support the US economy in this challenging time, thereby promoting our inclusive maximum employment and price stability goals. We have a ways to go yet, but as I look ahead, I am optimistic that as the virus comes under control, we can return to the more prosperous economic times we were experiencing before the pandemic. Thanks very much, and I look forward to your questions.
Thank you very much, Charlie. That was a very, very good talk. There are a number of questions that we have, often relating to inflation and interest rates, so I will start asking some. One, are you not concerned with the possibility of a very large increase in inflation given the large increase in the money supply over the last year and the increases that we have had in some commodities as well as some housing prices?
Oh, that's an excellent question. And, certainly for any economic students, reading textbooks and listening to lectures, that's a very natural question to be asking because we normally would expect that large, substantial increases in the money supply could lead to higher prices. The Federal Reserve's balance sheet has grown tremendously since the great financial crisis, the 2008 recession, Lehman Brothers bankruptcy. Reserves increased spectacularly, and now given the current situation, the Federal Reserve's balance sheet is even larger than that. However, it's a totally different situation than so many of those textbook writers were contemplating back from the 70s and 80s. We have had trouble getting inflation up to our 2% objective. It should be very easy, I would think. I would have thought, I did think, as a central banker coming into this position in September 2007, that getting inflation up to our objective is not so hard. Keeping it from going too much higher, that's what the real task would be. But in fact, it's been the exact opposite. There are long-run secular trends in long-term interest rates that around the world, globally, that have made it more difficult for central banks to provide as much accommodation through lower rates than we did before. That's a good part of what the long-run strategy was premised on. So even though we've seen a strong increase in monetary accounts, the Fed's balance sheet, we've been underrunning our 2% objective. The likelihood of us overshooting even to 2.5%, which would be welcome. 2.5% should be well within what our averaging 2% periodically would experience. 3% is not a problem either. But the relationship to economic growth, to vibrant labor markets, the so-called Phillips curve is much flatter, and it doesn't respond nearly as much as it did in the 70s and 80s and even the early 90s. And so we have to work harder to get inflation up. And until we get inflation up to say 2.5%, and we see risks of higher than that, I just have a lot of difficulty getting started thinking about that question, very seriously for the moment now. Things could change over time, but it would be a very large change that I'm not contemplating anytime soon.
A counter to that question is there is a large number of economists who are starting to wonder if the 2% inflation target on average is maybe too low. Do you have any thoughts on that?
That is a good counter. That is a good, looking at it the different way. I would say that the challenge that we're facing is, for the longest time, every time the US economy entered into a recession, the Fed was able to lower our short-term policy tool by at least 5 percentage points, if not more. And many times it was more than 5 percentage points. When we start off with a short-term interest rate of 2.5%, we don't have 5 percentage points to lower it. And so there's not enough accommodation in place. And so because of that, we went to asset purchases. Chairman Ben Bernanke, a student of the Great Depression and understanding also the Japanese experience with deflation that they had trouble getting rid of. We've done asset purchases, and that's an important part of our toolkit now. But all of this is because we sort of start off going after a 2% inflation objective that we're having trouble hitting. If our objective and inflation experience had been higher, if it had been 3% or 4%, then nominal interest rates and our short-term federal funds rate would be that much higher. It would be 2 percentage points higher, and that would give us more ammunition. Well, I mean, that's sort of a conceptual, theoretical, commentary. What we did during our long-run strategy framework was we, reaffirmed that our objective is 2%. We had said before that it's a symmetric objective so that it can be above as well as below, but we further emphasize that we should be averaging 2% over time, so that we should be experiencing inflation above 2%, well, perhaps as much as half of the time. And when we do that, then that would support stronger nominal interest rates, stronger growth, stronger real rates. And I think that, we can certainly make our 2% inflation objective work, especially when we have supportive fiscal policy and other policies, which also provide stimulus during times of downturn. But it is a total package. Monetary policy can't do it all. As Chairman Bernanke used to say, monetary policy is not a panacea. We need help. And if we had to do it all ourselves, then considering the inflation objective would probably be something to be considering again. But that's not where we are, and I don't anticipate that.
Given all of this that you're saying, it was asked whether or not maybe the relationships that we have learned involving inflation, unemployment, economic growth have to all be re-examined.
We're always monitoring the economy very carefully. I have a staff of economists with wide-ranging expertise from, econometrics, statistical, estimating, forecasting models, doing research, understanding empirical relationships between growth and inflation and unemployment and a variety of things, as well as labor economists looking at the structure of the economy and what the potential growth is. That's another big part of it. When our potential growth rates were 3 and 3.25% like they were in the 80s, real interest rates would be higher. That's another reason why you wouldn't need a higher inflation objective when productivity was stronger and real interest rates were stronger. But now we're looking at trend growth rates more on the order of 1.75%. And so I think it's a excellent topic for research as to how do we get more innovation? How do we get more productivity? How do we get stronger growth? How does that support our monetary policy making tools and what we can do with it? And, we just have to always be assessing that. That's what we kind of do as economists. I know I have enjoyed doing that kind of work throughout my career. And it's extremely important and meaningful. Any of your students who are interested in a career in economics, I would, certainly say that it's a wonderful field with lots of opportunities and many questions, burning questions that are really important. And the inequality issues that I was talking about earlier in the speech are just also front and center for anybody interested in a career in economics.
Changing focus a little bit, there is some concern among some of our listeners about the size of the national debt. You stress the importance of fiscal policy, given the size of the national debt, both in the US and in other countries. Is this worrisome, and how can it be addressed?
I think that's a very sensible topic for us to be talking about, thinking about. It's just completely natural for any of us as individuals, as households, to be thinking about our own financial responsibility. How do you meet your household budget? You've got a certain job opportunity, income, and how do you make your mortgage payment? How do you put food on the table? How do you save for your children's college education and all these kinds of things. And so living within your means, saving makes perfect sense. And so when you kind of take that logic to the state, federal government, you kind of go, well, shouldn't everyone else also balance a budget? Well, it turns out you learn in principles of macroeconomics that you've got the paradox of thrift, which is that if everybody sort of entertains belt tightening and cost cutting, then all of a sudden their demand for goods and services goes down. And if there's not some offsetting intervention, then that's going to reduce aggregate demand. So the federal government is often thought of as a counter-cyclical player in that to support the economy. That's why fiscal policy is an important part of the response. Monetary policy is also helpful for incentivizing businesses and individuals to take on a little bit more risk, which is commensurate with their financial responsibility, but because the costs are more attractive, then they can undertake that, and the economy can grow, and then everybody can be rewarded with that stronger growth. So this sort of comes down to what is the right size of the federal debt and the budget. And I think over sustainable periods of time, over long periods of time where things are going well, the economy is growing, you should definitely have a very responsible approach. It's always responsible, even when you're doing deficit spending in order to get the economy going. That's responsible. That's being very responsive, in fact. And so I think we have to be careful. We have to think about the horizon that's most important. And I think that when we, look back on the period, 2011, when the debt ceiling discussion took place and there was a lot of belt tightening at the federal government level, that reduced aggregate demand and the economy recovered more slowly and unemployment came down more. You could argue, well, that was more fiscally responsive. But if in fact the federal government was on the hook for more obligations because of that, that actually could have been short-sighted. So I think it's very important to address the needs of the economy. We do have to be mindful of the debt, make sure it fits within the size of the economy. But in the past, when the US government has run up the federal debt, the way that was dealt with is growing the economy strongly so that the existing debt fit within higher GDP growth levels.
Yes, that's true. And of course, at one point, taxes were not inflation adjusted tax rates as they are now. There is concern among your audience about income distribution. And one of the questions involved, do you think the $15 minimum wage will help that? And will that affect Federal Reserve policy?
So the federal minimum wage has not been adjusted for quite a long period of time. So therefore, its nominal setting has been eroded by price increases and inflation over that time period. So, the real burden of the minimum wage has been falling, by quite a lot. So any adjustment in the federal minimum wage could be thought of as sort of, going back to where we were before. Now, I think $15 is above, sort of the real value set, previously. There is a lot of income inequality. This is an adjustment that would, tend to, have a positive effect on anybody working at the minimum wage for their family. Now, it has a lot of different incidences. I mean, it also sort of helps second family earners too, and that's a good thing. There's going to be issues as to different regional cost of living baskets where $15 is going to be a little bit higher real burden for businesses and small businesses. And so, that'll have an effect that could be a little bit of a headwind. I think most of the economic studies that, have looked at this seem to indicate that the real, effect of this is really not that negative. But I think that's always something to study. I think you have to think about it as a multifaceted, federal program that is not just a, it could be definitely intended to help reduce income inequality and targeted some households and that. So is that going to have an effect on, Federal Reserve policy? That was another part of this. The way that I would go about thinking about this is what type of influence would it have on prices and inflation? And I don't think that there are many studies that indicate that this would have a big effect on underlying inflation. It might have a little bit of an effect on the price level, but not sustainable inflation rates. And so I don't think that that would be a concern for monetary policy.
There are a number of follow-ups on that involving modern monetary policy. Do you believe, or theory, do you believe that that could have an impact on the income distribution?
This is a question about MMT. Is that what?
Yes.
Okay. So I've read various accounts of what MMT are. I haven't really, read an in-depth, sort of theoretical framework written down. I'm sure that there are some. It's sort of easy to mix this across a number of different types of past streams of economic thinking, like going back to Alvin Hansen in the 30s and 40s, I think. What are the sources of demand, and that obviously comes from demand management, and that obviously comes from federal spending to some extent. And so to the extent that these are it's a way of enacting fiscal policy that's more expansionary, then that could lead to inflation once some constraints come off. You hit some supply constraints in the Phillips curve type thing. I kind of think about it like that. Now I know that I think the real MMT advocates think about it a little bit more broadly than that, but that's where I kind of go. I'm not quite sure of all of the details, but in terms of Federal Reserve monitoring of this, I think with our long run framework, we're extraordinarily well positioned to be thinking about what the setting of monetary policy should be. We're looking to reduce employment shortfalls. And so we always want to get the unemployment rate down. And now with this framework, we're announcing that, just if the unemployment rate goes below somebody's assessment of what the natural sustainable rate of unemployment is, that's not going to be an excuse all by itself in order to become more restrictive, because we don't really worry about that vibrancy of the labor market, except we want it. We want more of it. It becomes a concern if inflation starts to take off and is acting inconsistently with our objective. We've had trouble getting inflation up, but that would be sort of the margin for thinking we need a different setting of monetary policy. Now, if on top of that, you sort of layer on top of it some more MMT activity coming from fiscal policy, I think we're still going to be looking at the inflation margin as the one where, maybe the Fed would, have something to be thinking about. But those are sort of the details that I would be looking at. And I think our strategy is pretty well suited for, however that would be, however they would embark upon that.
Very good. Let's change topics a little bit. There's some questions involving the stock market. What is your view of the stock market boom in relation to the economy and the pandemic?
The stock market is definitely, at very high levels. It's hit, new records, in the last, several months, almost every few weeks it does that, maybe daily. I think corporations are doing pretty well. I think corporate earnings are pretty good. I think there's a lot of, innovations out there that investors are thinking about. And, that's always, part of what investment is, and, planning for your future and saving for retirement and your children's education. And so, naturally some type of investment in, risk-bearing assets as well as safe assets is what, good financial planners would advocate. I'm never very good at, knowing what the best valuation for, the stock market is. That's not what I do. It's not critical. Monetary policy is really focused on looking at how's the economy doing? Is it, are there employment shortfalls? Are we close to sustainable rates of growth? How's inflation doing? Stock market could be high or it could be moving around in different ways, even when the economy is doing well. So most of what I focus on is how's the economy doing. I do look at financial markets and whether or not there's volatility or risks that would put in place risks for the banking system, for households being able to borrow at reasonable rates, and things like that. And then that's looking at how it supports the economy. So it's very indirect, and I just have trouble ever making good is the stock market high or low. My yeah, I'll leave it there.
Given the disproportionate impact the COVID has had on small businesses, as you said, large businesses are showing fairly robust earnings right now in some areas. One of our audience members wants to know what kind of outlook is there for those kinds of small businesses trying to come forward?
Yeah, so during the pandemic, obviously small businesses which are engaged in close personal contact with customers and users have been hit very hard. Restaurants, any type of personal services, because of the risk of transmitting the virus. We've either experienced explicit shutdowns by local governments, state governments, or we've just seen customers kind of go, I don't want to go there, because I don't feel safe. Whether they could feel safe or not, unless people have confidence, then they're gonna hang back. So obviously, that has had a big effect on commerce and businesses. Now, I think it's disproportionate on small businesses. Now, there are large businesses like the airline businesses, and they've been, hit very, very hard as well. But small businesses, really, there's a lot of risk to them. You put up precious capital, you borrow your life savings, and then all of a sudden something happens, and it would be much too easy to be at risk of being wiped out and bankrupt. So I do worry that coming out of the pandemic, there's just a large segment of small businesses that aren't going to return. Now, maybe they come back after bankruptcy in a different form. They start a new business, things like that. But that's a slower process, and that gets in the way of continued vibrancy and innovation. So I do worry about that. I think that small businesses have been affected more than that. Small businesses inherently, for reasons that I was mentioning in terms of financing and their uncertain future, are a little bit more risky. And so, for any of your students who are, interested in the financial, type of market activity, financial analysis, which is also a very good, part of economic related profession. There are different factors that, require compensation, risk factors, and Eugene Fama and Ken French have sort of, identified different factors for investment loadings, and small businesses, small cap businesses are one of them. So they're riskier, they require more compensation, and this is why they're more cyclical as well. More recently, that small cap factor has come back in the last 6 months, but it was held down for quite a while, consistent with the thrust of your question.
As often occurs in a recession, personal savings rate has gone way up. Do you believe there's any chance that will continue post COVID, or do you anticipate it returning to its pre-COVID level?
I think that the personal savings rate has probably been elevated in part because of the nature of what we're facing. I think there's obviously a tremendous amount of risk of the spring of 2020, uncertainty, and the fact that the federal government made payments to households, which was very beneficial. And the unemployment insurance compensation was very substantial. And that was extraordinarily helpful. And there was a lot of concern among businesses that the rate of compensation for being unemployed was so high they were having trouble getting workers to show up, perhaps. And so now that was a very temporary program. It ended that generous nature, after July, and in fact, in a number of states, they didn't enjoy the same length of that. But for anybody who had that, they were able perhaps to save a little bit more, recognizing its temporary nature. This is in keeping with permanent income theories of consumption, that it's kind of like, I'm only going to get this for 3 or 4 months, so I should save this and try to spread it. And I think more people made rent payments for another month or longer because of that. They made car payments, and things like that. And they saved. So the savings rate went up because they had access to those funds and they had a need as well. I think as you go forward, there are a lot of people who, have gone through that, and that's why the additional relief payments have been very important, and continuing that would also be very important. Then you've got the income inequality and wealth inequality. So you have higher income individuals, college educated workers are more likely to have been able to work remotely. And so they've saved expenses on commuting and other things. And so saving rates have been higher. I think once we get back to a more normal setting for working, don't ask me what normal is, because it's going to look different than where we were, but how much different is a really good question. I think people are saving, against those uncertainties, and that could hold up. But still, I think it's more concentrated in higher income households, and there's still tremendous disparities for lower wage, lower income, moderate income workers as well, and they need more relief.
Last question. Do you believe that the stimulus package that is being talked about and eventually something passed in Congress will help stimulate the economy, or more just help individuals and small businesses and not really have much of an impact on the economy?
I think it will help the economy recover back to its potential much more quickly. I would say that Wendy Edelberg at the Hamilton Project Brookings Institution has done outstanding work estimating, depending on the size of the program and the nature of it, how much more quickly will we recover back to the economy's potential. And the current proposal, the $1.9 trillion proposal, I believe I saw that she, indicated that was going to fill almost all of the hole, and we would get there much more quickly. If you do something that's only a third of the size, you're going to take longer, and you'll, probably need more later on. Just in terms of what we are facing, it's possible that this kind of program is too big, in the sense that you could get by with less of that. The economy will do better. Vaccinations will come in full force, and then we're going to be that much better off. You know what? If that's the case, then that's a good thing to get the economy going, to get more people working, to give them, more skills earlier, the vibrant labor market like we had, before. There would be benefits to that. If it's not enough, if we have too small of a program, then it's going to take longer to get the unemployment rate down. There's a longer period where people aren't going to be picking up those skills, retaining those skills, and then that's just going to be very costly. We already ran that experiment in 2011, 12, and 13, where we had, I would say fiscal austerity, which did not support, return to vibrant growth quickly enough, and monetary policy couldn't do as much. And so just if you take the risks and you kind of go, if it's too much, I think we can live with that. If it's too little, that's going to be extremely bad for so many people. I think, doing more is better than doing less in the current situation.
Thank you very much. The audience has given very, very strong positive comments to your talk, and you had, even here at the university, over 180 people watching. So
wow,
thank you very much.
Professor Tracy, thank you very much. It's been really a wonderful experience. Glad I could be here virtually.
Yes, we appreciate it. And I know you are now going to do something with the media. So thank you again.
Okay, thanks. All right. Stay safe, everybody.